Traditional life insurance relies on long-term liquidity to remain actually stable. How do you prevent this new liquidity from introducing systemic distortions or mispricing of risk?
Any sort of token that we would issue, our protocol ensures that that really is reserved and locked up. By using the blockchain, we're able to eliminate some of the intermediaries that would be involved in a more conventional transaction. I think real-world assets in terms of digitization and tokenization are coming. Permanent life insurance, particularly whole life policies, are the ideal tokenized asset. This isn't some qualitatively new thing. It's just we're making it a lot more efficient and easier for the average user.
If tokenized policies begin trading on secondary markets, what safeguards prevent them from behaving like what happened with the great financial crisis?
Yeah, again, great question. And
today we have Dr. Robert Murphy, who's a chief economist at Infineo, which offers digital blockchain-based issuance of all life insurance policies. Dr. Murphy holds a doctorate in economics from New York University. And thank you for joining CCM, Dr. Murphy.
Thanks so much for having me. Looking forward to it.
So let's start with our chat today. Infineo frames life insurance as a liquid living asset, but traditional life insurance relies on long-term liquidity to remain actually stable. From an Austrian economics perspective, how do you prevent this new liquidity from introducing systemic distortions or mispricing of risk?
Well, sure. So great question. So just to clarify, any sort of token that we would issue in regards to life insurance, for example, our premier product is Lifecoin, and that represents $1 in cash surrender value of life insurance. I mean, our protocol ensures that that really is reserved and locked up. So it's there's no doubt that it's going to be there, as it were. So that's one element. Also, again, just for your listeners to make sure they understand that the sort of liquid cash element of life insurance pertains to what's called permanent life insurance policies. So if we're talking about something like a term policy, then right, you're not going to be able to go, buy a car pledging your term policy. That's not the kind of thing we're talking about here. So all of the digital tokens that we would issue on the basis of underlying life insurance is based on actuarial principles. And then the big thing that is going to be a theme probably throughout this interview is the transparency. And that's, I think we're going to get into this in a bit, but that's the function of having a blockchain involved and just having the transparency there, is that people can verify that, yes, if I think there's $10,000 worth of something here that is in fact there. So that's would be my answer.
You moved the insurance policies onto the blockchain, but the underlying risk still depends on real-world mortality and regulation. Where do you see the true value being created in the blockchain layer itself, or in rethinking the insurance contract, and what part is most at risk of being overhyped?
Okay, yeah, so great question. So I think there's a few different elements that all sort of come together here. So one element is that by using the blockchain, we're able to eliminate some of the intermediaries that would be involved in a more conventional transaction. So I want to be clear, everything we're doing in principle is already being done, in an analog fashion. And in fact, in infineo, we already are still doing this. That's how we know that what we're scaling up to do, in a digital version can already be done. We don't need to have different regulations in place or anything like that. This is all can be done. But right now, for example, if some investor wanted to gain exposure to life insurance as an asset class, that would be very difficult to do because life insurance products are, bespoke in a sense. And like for them to like, if it's a permanent policy, to get into the stage of the policy where it really starts earning a decent rate of return, you have to wait several years and so forth. So, for example, by pooling life insurance and then issuing tokens that are claims on some of the underlying economic value, that allows people to gain exposure to that. And so when you start thinking of, that's the sort of thing we have in mind, that's why in order to do that in a low-cost manner and to be able to scale quickly using blockchain and AI is really essential. So that, because again, you would need to verify that the policies are in force. You'd have to update them constantly in terms of as their cash values evolve over time. People might be concerned about things like which carriers are issuing them. So there's a lot of real world considerations there that by having it, on the blockchain and then using AI powered engines to sort of appraise the things and communicate the information, that's all pretty essential in order for this thing to scale. So as far as your question, like in terms of what could be the thing that would overhype it, I suppose it's common whenever people come out with some new product that we're going to have a real world asset, we're going to digitize, and the first thing to sort of pump the brakes is to say, well, what is it that blockchain does, for you guys? Like, could you do this in principle without using it? And so I think, that's true for us as well. But my answer there is that I would say it this way, that I think real world assets in terms of, digitization and tokenization are coming. Like they're already here. And to me, to say like, oh, could you do this without using the blockchain? The answer is yes, we are doing it without the blockchain. But to me, that would be like somebody in, the year 2005 saying, oh, do you really need to use email in your business model? Couldn't you just write people letters and put them in the mail? And yeah, you could, but that would slow things down. And since the whole industry is moving in this direction, I think it's the same thing here, that you have, tokenized real estate, tokenized gold, tokenized treasuries, and so on and so forth, tokenized stock. And I think the issue here is, for various reasons, permanent life insurance, particularly whole life policies, are the ideal asset for this procedure, like the ideal tokenized asset, real world asset, for various reasons. Among others, they have the highest Sharpe ratio, for example. I've done some analysis in infineo on that. So that would be my answer, that if it makes sense to tokenize any asset, I think whole life policies are the number one candidate.
If policyholders can access liquidity earlier, how do you avoid fundamentally changing their incentives? For example, treating life insurance more like a short-term financial instrument rather than long-term protection?
Okay, yeah, great question. And so that is definitely a concern. And so again, just for the listeners to make sure they understand the potential risk, that yes, if somebody is sitting on, a life insurance policy that maybe they bought 10 years ago and they kind of forgot about it. Oh, that's just the life insurance that's there, in case I die, something happens to me. And then Infineo comes along and says, hey, we're giving you these tools to be able to sort of access that liquidity in a much more convenient and attractive fashion than you can. Because right now you could still go to a carrier and get a policy loan, right? So this isn't some qualitatively new thing. It's just we're making it a lot more efficient and easier for the average user. And so, yes, the concern might be, if we're giving people this option and make it so easy to, in a sense, access the liquidity against your policy, then, when someone dies, does that mean they don't have enough net death benefit remaining for, the things that they originally took out the policy for? So we have safeguards against that. And primarily it's to make sure that the users are educated. And so part of what Infineo is developing are, online tools, educational tools like, interface AI agents and so forth that, with your consent, if you upload your policy and ask questions about it, it can do financial projections and show, these are the various scenarios. And then the other thing too, I want to just stress is partly what we're doing, or, one of the many menu of items we're bringing to market is the ability that somebody could, take a chunk of cash value that right now is sort of sitting there, mint Lifecoins against it, and then deploy those to earn yield. And so, as far as the underlying policy is concerned, that's still, chugging along. And so the other things that are happening are, in a sense, are just excess on top of that. So as long as, the underlying structure and the investments are sound, that this is all, it's not going to impair the policy. So there's that element as well. And again, it's ultimately, there's always trade-offs involved, but educating the consumer. And I would say, I think we'll probably get into this further in the discussion, that the underlying stability of the asset, I think, is what makes this far more conservative than other, doing this type of thing with other types of assets.
You mentioned tokenization, and we know that the Austrian School of Economics emphasizes sound money and skepticism toward financial engineering. So my question is, how do you reconcile that with tokenizing insurance policies, which could introduce new layers of abstraction and speculation?
Yeah, so great question, and it's so yes, many fans of the Austrian school in general, and then its adherents stress the virtues of what they would call sound money, and that's why they don't like government issued fiat money. They prefer back the days of gold and silver coins, or when sovereign currencies were backed up by gold and or silver, and also a lot of the more recent shenanigans on Wall Street and so on, that a lot of hard money, sound money types recoil from that. And so in that context, is very apropos of your question that life insurance is viewed as an asset class that's outside of that, Wall Street, big bank nexus, that the life insurance industry as a whole is very conservative, has been around for a long time, very dependable. But also it's not some niche thing that nobody's ever heard of. It's, everybody's got life insurance. And so I think that's why it's such a good candidate to be a different locus of financial activity away from these other sectors that are riskier. And so just to give an example, what I said earlier, so like, the product Lifecoin that we're developing, again, one Lifecoin represents, $1 of cash surrender value in life insurance that we, can show through blockchain verification is segregated, that the person can't be double dipping against it. And so if people are using that as a foundation for, some financial investment or what have you, that's 100% reserve, right? So part of the standard Austrian critique of our current system as it's in practice today is that the banks don't have 100% reserves, and in the Austrian view that, causes the boom bust cycle and just standard price inflation, right? That the banks, in a sense, by lending are creating money out of thin air, is, a colloquial way of putting it. Well, when we're talking about here, like people accessing, their cash surrender value and then going and, doing things based upon that, there's no, we're not creating money out of thin air, that we really are, segregating the collateral, and then we are having other people lend against it and then funneling that to the policyholder. So again, this isn't involving inflating the number of dollars in the system. So that's what I would say, that the way we're building this, it is going to be, consistent with Austrian principles.
You mentioned the big banks, and so this links to my next question, because if tokenized policies begin trading on secondary markets, what safeguards prevent them from behaving like we know the structured products pre-2028, where complexity outpaced actual risk understanding? So, I mean, what happened with the great financial crisis?
Yeah, again, great question. And I understand the concern. For example, in some settings, we're describing what we're doing. Again, we're offering lots of things. Like we're just, giving like a new operating system for life insurance is one way of putting it. So there's a lot of different things that we, when we're brainstorming, like, oh, wow, if we build these tools, what sorts of things could clients do with it, or, potential investors and whatnot. And so, yeah, one idea is that, if people, can put their policies into a pool, and then we could issue fractional claims on the pool, in a digitized, tokenized format. And you might refer to that thing as a life-backed security, right? And then, yes, that nomenclature might alarm some people because they, that sounds like a mortgage-backed security. And in some respects it is, but I would say there's a huge, very critical difference between the two, is that, a standard whole life policy has built-in contractually guaranteed increases in the cash value. And so that's why, in our opinion, it's a much better foundation for, other products that are sort of like derivatives built on that, if you want to use that language. And so the analogy I use is, imagine back in the 2007, 2008 crisis, if whenever a builder, built a home and sold it to somebody, there was a contractual guarantee that, every year I have this standing offer that I'll buy the house back from you at a higher price than last year. And just every year, contractually, if you ever bought a house from somebody, the builder himself agreed we would buy that back from you according to this schedule, over time. And that's what a whole life policy is. It has the built-in cash surrender value where the issuer of the policy, namely the carrier, says, and it's in the contract, year by year, if you wanted to surrender the policy, we will give you this cash for, spot payment to walk away. And that number just steadily marches up over time. So that's why we think these, as opposed to the real estate market where things might be fully collateralized and, we got a lot of margin. And so, but then if the real estate goes down 40% in 3 months, that all goes out the window. Whereas here, it's contractually, they can't do that. So yeah, I mean, the carriers could all fail and so forth. I mean, you can come up with Mad Max scenarios, but I'm just saying in terms of an asset that the price could just fall through the floor, that's not what we're talking about here.
Let's do a step back to real-world events that are linked to insurance policies. Since payouts depend on real-world events like mortality, for example, how do Infineo deal with the oracle problem, ensuring that off-chain data feeding into systems like blockchain is trustworthy and not a single point of failure?
Yeah, so this great question, and here is the the primary challenge we face at a conceptual level in terms of, because you could say in an elevator pitch, oh yeah, we're going to tokenize life insurance. And yeah, people are tokenizing real estate, they're tokenizing bottles of wine and sports cars, and we're going to tokenize life insurance. And that sounds great, but when you start getting more specific, well, how can you do that? Because among other problems, and this is why I'm going through this to answer your question, is there's a lot of sensitive personal information on a specific life insurance policy, like, the name of the person who's insured, their health rating, and, things like this. So clearly, in the interest of transparency, it wouldn't work to put all of that stuff on the blockchain, because then anyone could just go and look at this particular policy and, oh, Jim Smith here, I see he's 58 and he's got, he's a smoker and so forth. All right, so and he's underwritten for this amount of death benefits, so I can have a clue about how wealthy he is. Right. So obviously that wouldn't work. So it's a tricky trade-off. And so what we've done in practice is you're putting enough information on the blockchain so that outside, investors or just people in general who care about it just from a purely financial perspective, for example, reinsurers might want to know what carriers issued policies. And that way, if they wanted to hedge themselves, and they could just, rearrange, a pool of things of that nature, depending on the carriers and the types of policies, stuff like that. But clearly not putting, individual names and things like that on there. And then you're right. Another critical issue is, okay, let's say we do have a policy on the blockchain. Well, what if the person 3 years from now stops paying his premiums, right? There has to be a way that the blockchain, knows that. And so what the solution we've come up with, that sort of gets to your Oracle question, is that in the information on the blockchain that, we have a URL that points to a system such that somebody who has the right authorization is allowed to click through and then get information provided by the carrier to verify the authenticity and the fact, this policy is still in force. So there again, this is all, we're building this as we speak. So it's not that I can tell you more specifically than that, but I'm just saying that's the type of trade-off that we're engaged in. So yes, the Oracle problem, is there. And I'm saying right now, in terms of policies issued from conventional carriers in analog format, that, there is still always going to be an issue of if the carrier has to agree that this policy is in force. And so that's the trade-off that we're using right now. Eventually, we think that, the industry eventually is going to go to just a native digital issuance. And there, I think, you really could use smart contracts and make it more decentralized, such that, somebody could verify and could be informed as the status of this policy without there being some third-party institution that you kind of just have to trust.
Do you see infineo is just innovating within the insurance frameworks, or it's exploiting regulatory gaps between traditional insurance and digital assets? And if so, how sustainable is that distinction long term? Yeah,
good question. I don't think that we're engaging in regulatory arbitrage, to use that fancy term. Like I say, the types of things that we're doing, that we're building right now to provide to clients, this calendar year, for example, is all stuff that's being done in analog format already. And it's just the tokenization and digitization just makes it easier to scale so that we can, provide these same services to more people without us having to go hire, triple our workforce. So I think there it really is just a matter of stuff that you could have done 5 years ago in an analog format, and we can just do it with fewer man hours on our end to hook up the relevant parties and have the transactions go through. So I don't think that that's involving different regulatory treatment of like life insurance versus digital assets. That it was more the other way around, that stuff that could be done in an analog format, we had to just make sure if we were going to try to do it in a digital way, that your property rights were just as secure over in that realm as they would have been in the analog way. So that would be how I would describe it more. It's not that we're like exploiting loopholes or something. It's more the other way around, that we want to have the protection in place in the digital realm. And with this, the second Trump administration coming in, a lot of the, rulings that they put out in the Genius Act and things like that have provided much more regulatory certainty on that front.
Let's talk about artificial intelligence. AI-driven underwriting promises efficiency, but it can also embed invisible biases. How do you ensure that increased automation doesn't create new forms of exclusion or mispricing that, are harder to detect than in traditional models?
Yeah, great question. And sort of to tie it back to like the '08 crisis, my understanding after things blew up and I was calling it, not on the record, just like, people I knew saying, how would this, why this wasn't benefiting you guys either, like at investment banks and things. And yeah, one of the things they said was, we didn't really understand these mortgage-backed securities. These things were really complicated. We had a bunch of physics PhDs down the hall and they ran their formulas and, and that's what happened. So here, I think, again, the transparency of the blockchain is going to help so that at least everybody will be able, in principle, to click through and know exactly what it is that we have exposure to. And if you have some sort of derivative product, we'll understand all the constituents going into it. And so you're right. If some particular life insurance appraisal model or engine gets popular and then everybody in the space just starts using it, and if it makes some simplifications that, a certain type of policy might be overvalued or is valued correctly under normal circumstances, but there's a weird scenario that it wasn't considering, and then that thing hits. Yeah, in principle, you could imagine scenarios like that. But again, all I would say is the beauty of using AI in a decentralized blockchain approach is that there aren't just going to be one or two companies in the space, right? Like people can come in. So yeah, Infineo, we think that we're going to be the dominant player in this space in the foreseeable future, just because, we've been working on so much. There's a big moat, we believe. And for people who don't, like, there's a lot of stuff that you have to figure out to do this, right? That it's harder than it sounds. But again, once this is up and running, nothing can stop some competitor from coming along. And if they think that we're mispricing something, they can have their own engine and come. So again, that's part of the beauty of open competition, is that you have that feedback. And again, in case that sounds, too optimistic and say, well, what happened in '08? I think partly happened back there. They didn't have enough different people using, AI engines or whatever. Because that's the thing. It's not just that one firm has to make a mistake. It's that everyone has to keep making the same mistake, and people have to ignore the huge profit opportunity from realizing that, right? And so here, again, I think, open competition as more and more people get into this and everybody begins using AI in their own internal systems. That's if somebody is mispricing something at a fundamental level, somebody's going to see that and exploit it.
Let's imagine a stressed market scenario, for example, a liquidity crunch. What happens if a large number of policyholders try to unlock value simultaneously, at the same time? Does the model rely on continuous liquidity? And if so, where does that ultimately come from?
Okay, yeah. So great question. So one point of clarification, again, part of the there's different elements and things that we have on, our long-term planning horizon. But in terms of near-term, services that we provide for our clients, again, you have a life insurance policy with cash surrender value. We're going to allow you to tokenize it and to create something called Lifecoin, and then, deploy it and do things with it. And so in that context, then, if there's a credit freeze, there's a systemic shock and just lending dries up across the board. So certainly, like, newcomers, that's fine. Then they could mint Lifecoin, but like if people aren't willing to lend against it, then they wouldn't be able to do too much of this. So that's fine. And then as far as people who already were up and running, and you're wondering, well, what happens to them? Well, again, we're going to be very clear about the rules of engagement, and that, yes, if you have minted Lifecoin against your policies, we can verify that we've got that locked up, and that, you can't double dip against that. And then, for example, if we're going to go deploy it into some investment, somebody else lends against it in order to fund that, the contracts would all be in place and have quite clear directions and protocols and hierarchies in terms of, redemption and so on. So that's the way we're approaching it, that just be very clear up front about how long do you want your money to be locked up for, and then just to ensure if somebody really, wants the ability to say, hey, I want to be able to get my money back in 30 days, well, then we just deploy it to things and that make sure that that's the maturity of the underlying asset. So yes, what we're definitely building to be conscious of is to not allow someone to, borrow short and lend long, that we don't want to have maturity mismatching within the system itself. And again, just to beat the dead horse, that's the beauty of doing it with decentralized blockchain and AI engine, is that we can scale and tailor everything appropriately.
Thank you, very clear. We talking about the future. So looking 10 or 15 years ahead, what specific shift would convince you that this model has truly transformed the insurance, not just digitized it, and that will still need to change for that vision to be complete?
Well, I think, again, that just standard investors, like portfolio managers, things that if they viewed life insurance as a separate asset class, like how they have real estate, they got fixed income, they got precious metals, equities, and if they viewed life insurance as its own asset class, and that people made portfolio decisions on the basis of, I'm going to reduce my exposure to life insurance, that I think that is coming, and that would be one indication in my mind that yes, and if Infineo contributes to that transformation, I would be pleased to see that. So that's one element, but just more generally, that yes, the people can go and log on and just see the performance of their various life insurance assets, and then the digitized tokens corresponding to them, and just in a very simple dashboard format, and giving them feedback. To me, that really would show that what we're setting out to build has come to fruition.
Last question, just before leaving you. This is a question that I get a lot of, because I also come from, covering more macro rather than stuff, because I come from stock equities coverage and then moved to crypto. So as blockchain and artificial intelligence continue to evolve rapidly, what's the one principle, whether from the Austrian School of Economics or your own experience, that you think the industry must hold on to avoid repeating past cycles of over-innovation and hype?
Yeah, so great question. And I think I would just sort of circle back to some of the earlier threads that you were pulling on there, that fundamentally, and consistent with the Austrian theory of what causes the boom-bust cycle and such, is the maturity matching. I think that, if I had to say it in a phrase, it'd be maturity matching, and just to ensure that people don't believe that they have their cake and eat it too, right? That they understand that, if you're deploying some of your wealth to earn a yield somewhere, that means you can't spend it at the same time, or that you're locking it up. And so like I said, the systems we're building is all consistent with that. And also too, in terms of like the Genius Act and the coming Clarity Act, at least its current status, what we're doing is all consistent with that. And I think recognizing the idea that yes, with these stable coins and things like that we want to get away from the model, which is ironically is what standard banking is right now, commercial banking, where people think, I got money in my checking account, but you kind of also know the bank lent that out to somebody with a 30-year mortgage, right? So that those two don't match, and that's why there's runs on banks, in the old school approach. But here, as long as everybody keeps in mind maturity matching and transparency, then I think that we have a solid foundation to build on.
Perfect. And thank you very much, Dr. Murphy, for joining CCN, for the insight, the great insight that you gave us. Thank you again for your time.
Thanks for having me.